the avoidance of doubt, the Simple Side does not provide investment, tax, or legal advice. As with any asset, the value of any asset class can go up or down, and there can be substantial risk that you lose your money buying, selling, holding, or investing in any asset. You should carefully consider whether trading or holding assets is suitable for you in light of your financial condition.
All right, everybody, welcome back to another weekend newsletter from the Simple Side. We're going to jump into our portfolio performance, all of our one-off stock bets, and we'll talk a little bit about why the market dropped so much and if we should be worried. Let's get into it.
Welcome to the Simple Side. Market beating picks inside. There's no jargon and no time to waste. Join the Simple Side and end up in first place.
All right, we can talk about the stock market and all of the insanity that just happened this past week. But before we get into what we think about all of that, let's quickly talk about our managed portfolios that we talk about and share with subscribers for free on the newsletter. The two portfolios that I'm going to talk about here are available to copy trade on Autopilot. And like always, there'll be links in the newsletter all over the place for you to go and find these portfolios on Autopilot to go and copy trade them. But both of these portfolios aren't exactly built by me. They're managed by me on Autopilot, but they're built from external sources. One of those sources is Perplexity Finance. The other one is InsiderEdges.com, which is an insider trading, 13F tracking, hedge fund tracking platform that's available. And you guys can go and look at that and find that and use them and their stock picks if you so choose. But we just happen to manage their portfolio on Autopilot. Let's start first with the Perplexity Finance portfolio that we're managing. Currently, the portfolio has something like $850,000 of assets under management, and that's spread across about 100 different people. Year to date, the portfolio has been doing extremely well, up 28.78%, while the S&P 500 over the same period of time has only averaged 7.96% returns. So pretty impressive returns there. And again, over the past 3 months, we're up something like 20%. Again, outperformance against the S&P 500. Over the past month, we're up 4.48%. Again, outperforming the S&P 500, which is only up 1.9%. And then over the past week is where things start to get a little bit ugly. We're down 3%, 3.06% to be exact. And the S&P 500 over that same period of time is down 2.5%. So a little bit of underperformance in the short term, but when you zoom out, when you look at the big picture, we're outperforming by quite a vast margin there. And we're very happy to be sitting in that position with this portfolio. Now, if we want to talk stocks and the allocations that we're seeing in this portfolio, it's pretty cut and dry, pretty simple. Micron is the number one pick in the portfolio with a weighting of 7.36%. We're up almost 280% on that stock. Google sitting at the number two, allocation on that is 7.28%. And, so about 0.1% less than our Micron position. That's up about 15%. And then in the number three position, this has been a relatively new one from Perplexity Finance over the past few weeks. It's been growing the position in XLU. That XLU stock is the utility sector. And so it's tracking the utility sector there. That's a 7.21% weighting, and that's down about 1.4%. So I think if you look at the broader market downturn that we just recently saw, the large sell-off that we saw on Friday especially, the XLU purchase starts to kind of make a little bit of sense. It's looking for a little bit of stability while a lot of the other things in the market are on rocky ground. The next couple of stocks we have on the list, Amazon, Microsoft, United Health, Lam Research, and then we have a Schwab US dividend ETF. So those really make up about your top 10 picks there. Overall, like I said, performance has been very well. It's well to do. New stock picks come out for Perplexity Finance every Monday morning. So if the AI decides with the information that I feed to it that it wants to make some sort of a change, it'll let me know then. I'll go in, I'll make the change, I'll make the adjustment, and then the portfolio will continue on. Again, the goal I think for this portfolio is just to have extended, slow growth, looking for anywhere upwards of 8 to 10% returns per year. So a slight outperformance of the S&P 500 is what we're going for. Recently, we've seen a large outperformance against the S&P 500. Hopefully that continues, but only time will tell. All right, the next managed portfolio that we have is the InsiderEdges.com portfolio. This is a newer one that I just started tracking on the Autopilot, and that means that we don't have as many subscribers or as much assets under management under this portfolio yet. But I think over time, and from what I'm gleaning from the InsiderEdges.com website, we should start to see this portfolio pick up and outperform over time, especially in bull markets. So we just started this portfolio, I want to say about 3-ish months ago. And so over the past 3 months, we're up around 11.75%. Again, the S&P 500 up over that same period of time, 8.25%. So outperformance there. Over the past month, we have been struggling, down 2.55%, while the S&P 500 returns 1.9%. So we're down a little bit under the S&P 500 over that same period of time. But over the past 3 months, again, zooming out at the bigger picture, we're seeing some outperformance from the portfolio there. And then this past week, the portfolio just got smoked really hard, down 5.61%, while the S&P 500, like I said earlier, down only 2.5%. So underperformance again over the past week should be no surprise, heavily indexed in tech, as many hedge funds and 13F investors are. And so, of course, we're going to see some negative performance, especially when we watch the NASDAQ take such a sharp fall. So the way the InsiderEdges.com portfolio works is we take all of their premium portfolio stock picks that are available to subscribers that use the website, and we put them into a portfolio, and we offer that portfolio for people to copy trade. Now, if you look back at the historical, rankings of the portfolio, we've seen the premium picks portfolio perform at about 17% per year, and we've seen the monthly picks portfolio perform at about 22% a year. So if you want to go and check any of that out, again, just go to InsiderEdges.com. But we'll talk about what their top positions are at the current moment. They currently have 14 positions. I think 4 of those are coming from the monthly picks portfolio. The other 10 are coming from the premium picks portfolio. And they're allocated as follows. Microsoft is the largest position by a pretty wide margin outside of the top 3 holdings. Allocation percentage is 16.17%. Current return since that stock's been invested in is 4.2%. Amazon is the number 2 position. Allocation is 15.19%. Current percent return on that holding is 2.4%. And then at number 3, the one that is lagging relative out of these top, large holdings is Meta. Allocation is only 10%, so 5% less than the other 2. And we're down about 2.1% on that holding. And then I think the next couple of picks are where we start to get into more of the premium picks territory. Cloudflare, ticker NET, allocation 6.56%. We're up 23.6% on that holding. Natera, this is a pick from, I believe, Stanley Druckenmiller. Allocation is about 6.11%. We're up around 10% on that pick. And of course, I'll include a picture here so you guys can go and check out the rest of the stocks we hold and how they've been performing. In general, I think this portfolio is set to do well over time, especially in periods after we see stock market drops like what we've seen today. Of course, I wish we were going to get a bunch of 13F filings tomorrow so that I could go jump over to Insider Edges, find all the important stock picks, invest in those companies, and then take that and run with it. Obviously, we don't have those new filings coming out now, but we'll be watching for those along with Insider Edges at some point in the future. But For our managed portfolios that are kind of external to what we offer to paid subscribers on the newsletter, that's all we have. We're going to jump into the performance of some of these other actively managed portfolios that are under my care here in just a moment. But I wanted to share two portfolios that have actually been performing very, very well that you just can't access really through the newsletter. You kind of need to be on Autopilot to be able to copy trade those portfolios. Of course, they're included in the newsletter. You're going to be getting these every week now. So if you wanted to just adjust your portfolio based on what you're seeing from my weekly performance updates, you can absolutely do that. You can copy along without paying any money to Autopilot. But the Autopilot just makes it quite a bit easier. All right, for free subscribers, I just want to talk about all of the portfolios and the returns that you are missing out on if you're not a paid subscriber. And if you are a paid subscriber and you just copy these portfolios that we're putting out and you just want to know in general, how are things performing, this section right here will be for you. We're going to start, like always, with the flagship fund, which has kind of been my main investment vehicle for my own personal portfolio since about 2020. If you don't know, it's been averaging about 39%, really a 39% CAGR, compounded annual growth rate per year, not including 2026. And so it's done very, very well. But I would like to say that there's a huge caveat here, which is we started in one of the greatest bull markets of all time. And so we've been very lucky to pick up the performance that's offered to us as well. I still do believe very strongly in the methodology that I have in finding stocks and putting them in my portfolio. I think the largest drawdown that we've seen has been 36%. And so, we're willing and able to accept return or downturns like that when we know that almost every year we're going to be returning, anywhere from 30 to 40%. Now, I think that will decline as time goes on. I expect us to get closer and closer to the 20% returns per year, which I would feel comfortable with if we could sustain that. But regardless, let's talk about some returns. One of the things that I've loved to say, and I'll talk about it over and over and over again, and sometimes I do it as a reminder for myself, is that we were really over-indexed into the software sector. I think something like 60 or 70% of the holdings that we had in the portfolio were in the software sector, and they really didn't fit the investment thesis that I have built for my personal investing journey, which is high quality companies that have profitability that are growing very fast. That's what I like. I think it's a very simple way to look at the market. You go and you find a stock. The stock is doing very well. It's got strong fundamentals. There's not too much debt there. And you say, is this company growing? The company's growing very quickly relative to many of the other companies that could potentially fit in the same vein. And then you say, that's the one I want. And it just makes sense to me to say, here's a company that has good management, that's managing the company well, and it's growing quite quickly. It's hard to look at a company like that and say, this would not make a good investment. As for the software sector, I think it's harder to tell whether or not you have a quality business. There's so many legacy businesses that exist in the industry. And I think I was sort of blindly taking these companies at face value, and I liked their margins and their growth more than I really liked the actual business model or the quality of the underlying business. A great example is Paycom. I was invested heavily in Paycom. We use Paycom in one of the businesses that I work with, and we don't exactly like the way that it works. It's not super customizable for things that we need. It's pretty cookie cutter. It works really well for many of the legacy brands and businesses that have been built on top of it. But I don't really like the software. I don't like the reporting. And yet I still invested in the stock. It just didn't make much sense. And when you do that, and 60% of your portfolio is built into companies like that, all of a sudden you're experiencing negative returns in a portfolio where you should be experiencing the opposite. So that's a very long-winded way of going about what I was trying to say. Basically, if we had not made this software error at the beginning of the year, our portfolio would be up 14.52%. Now, sadly, we did invest in all of these software companies. We over-indexed in them, expecting high returns. It didn't end up that way. And so, year to date, our flagship fund is now only up around 5%. Obviously, this number will change if you've been investing into the portfolio over time or DCAing or anything of that nature. But for now, year to date, we are up about 5%. Over the past month, I think we're up about 3.8%. And quite honestly, I feel like that's not something worth complaining about at this point in time. Now, if you go and check the Autopilot page, I think it'll tell you something a little bit different. It might say like 1.5%. And that should, as far as I know, should not be indicative of the returns that you should have from these companies. That's the total aggregate performance. So some people might have bought sooner. Some people might have bought into the portfolio later. And so that aggregate performance on Autopilot adjusts based on the total amount of capital that's been put into the portfolio and how it's performed. Over the past 3 months, we're doing fair, I would say. We're up about 8.41%. The S&P, again, up 8.25%. So we've almost matched them. I believe that if you took away this negative performance on Friday, we were just starting to break away from the S&P 500. We were up about 14.33%, while the S&P 500 was up 11%. And we were starting to kind of pick up momentum in that growth as well. And we'll talk more about what I think about the overall economy and portfolio sometime here in the future. And then, of course, like everything else over this past week, the flagship fund was smoked. I think going into Friday, the S&P was about even. I think it was about 0.08% returns in the S&P. And then the flagship fund, the poor flagship fund, we were up 3% going into this Friday. And then we ended the week, again, getting smoked along with the S&P, down 2.37%, slightly above the performance from the S&P 500, but still struggling quite a bit. But that is the performance that we have there. Now we get to talk about a more interesting one. That's the tech growth portfolio, which I think you could absolutely say is the tech loss portfolio when the market does downturn like it did this Friday. And yes, we absolutely experienced that. Year to date in this portfolio, we have just been struggling. We cannot seem to get a foothold on the performance of the portfolio. We just seem to constantly have losses, even though I do believe we have some very strong holdings in the portfolio. They just haven't really been able to find their footing. Year to date, let's see what I have the performance at. I have it sitting at around negative 5.9%. So down about 6% on the year. Of course, performance that I just distaste so much. And of course, this is just another one of those portfolios where we had great momentum coming into this week. We're starting to very, very quickly outperform the S&P 500. And then, of course, we saw this big sell-off. But that's how a lot of high-growth portfolios work, and most people understand that. If you're going for high growth, you're typically picking up a lot of downside as well when the market does turn. So let's see what we're looking at for returns over the past month. I'm showing an increase of about 3% over the past month. Again, at one point in time, we were showing 14.45%, and that was at the same time the S&P was experiencing 11.49%. And then, of course, the last couple of days in the week happened, and we just dropped off of that cliff. Over the past month, the S&P 500, again, ending at 1.9% returns, us ending negative 0.83% returns. And, of course, a lot of that negative performance, again, coming in the latter half of the week where we just ended up underperforming by vast margins. Again, I really think as long as the current as long as the current investing environment stands, we'll start to see outperformance in this portfolio in a big, big way. Our monthly picks this month are doing okay. There are some that are doing worse than others, but they're doing relatively solid. And I just think that we're close to seeing a breakout here, but when the market turns, we struggle. And that struggle continued in one of our top performing portfolios, the AI secondhand effects portfolio. We've got around $900,000 invested into this portfolio. And year to date, we've seen pretty solid performance, up anywhere, I think around 12%, 12 to 14% is the performance that we've seen year to date out of this portfolio. At times, been up as high as 28%. And then, of course, sell-offs over the past week have driven that number a little bit lower, but it's nothing that we're very concerned about. I think we have a lot of great investments with room to run in this portfolio, and I think we'll see that happen over time. Over the past month, the AI secondhand effects portfolio has struggled quite a bit, down about 6%. I think in the Autopilot, you'll see that we're down around 10%. So that's, again, client aggregate performance. So I think we've just had some unlucky bad buys go into the portfolio, making that performance look a little bit worse than it is. But over the past 3 months, it's nothing too terrible. We're up about 4.49%. S&P 500 up 8.25%. And like I said, there's been times where over the past 3 months, we've been up 17% against the S&P 500, 7%. Or up 13% against the S&P 500's 11%. So again, another one of those areas where we're looking for high growth. We're getting that high growth over the long term, but we're experiencing a little bit of downturn, or I guess a lot of downturn when the market turns, which again, should really come as no surprise to anybody here. We did just recently make some transitioning investments in this portfolio, buying into a couple of companies that are not exactly energy focused, but are a little bit on the other side of things. We've made some investments into some more AI, quote unquote, bottleneck companies here. And so we're kind of waiting to see how those play out. I think the drop off this week gives us the opportunity to potentially go a bit deeper into some companies that we wanted to go into before, but we're just a little bit worried about putting big dollars in with things being so expensive. And so there is an opportunity for us to change up some of the holdings here. I would like to see how things play out on Monday when the market opens, because there is always, I think, this opportunity for things to open up lower, or even if they open up about flat, for us to kind of make those investments if we feel like it's the right time. I've been watching how the portfolios have been performing on insider edges of some of these large AI bet type guys. And I think last week I saw Leopold Aschenbrenner. He runs the situational awareness hedge fund. He was up something like 16 or 20% last week. And now this week I saw he's only up 5.62% on just his equity holdings. So I think there's something to say there about some of those opportunities maybe coming due. And then another guy that I kind of look to for some of these AI bets is Gavin Baker. He was up, I think, something similar, 16, 17% last week. Now he's only up 7%. And so he's got some interesting holdings that I do like quite a bit. Ciena Corp being one of them, Micron being one of them, Amazon, NVIDIA, and then Astera Labs, ticker ALAB, is another one. He's up about 47% on that pick since he reported his holdings just a few months ago. And so those are things that I'm looking at as well. He's also got holdings in companies like Coherent Corp, ticker COHR, Lumentium Holdings, I think that's how you say that. It's ticker LITE. And then EchoStar Corp, which has just been a huge one for some other investors over the past couple of years, ticker SATS. And so those are some areas where I think there is potentially some opportunity to maybe look at or dive into. Another one, he's got Credo, CRDO, and he had a new buy into Palo Alto Networks, ticker PANW, another one that's interesting to me. So there's a lot of opportunity that I see in some of these hedge fund portfolios that I'm really interested in potentially buying into. And now that we're starting to kind of see these stocks retreat a little bit, I think this is where we're getting an opportunity to maybe add into a couple of these companies that have had those sell-offs. So I think the last thing that we have to get into is just our stock research. Of course, that's able to be found on our website. It's thesimpleside.news/research. So you should be able to go to that website and see all of our stock research if you're a paying subscriber. And I think currently we've made a total of 25 picks, and I think 7 of those picks are still open. So what that means is we've got 18 that have closed, 18 picks that we have either manually closed the stock trade or we have let the time that we expected the trade to take to expire or anything of that nature, or we've hit our target expected price. So 18 of those trades have closed, and of those 18 closed trades, we have 14 winners, which means we only have 4 losers. And we just recently had a couple of trades finish that just did very, very well for us. One of those was Oracle, ticker ORCL. This stock just did very, very well for us. We entered in at a price of $151. We closed out the trade at a price of $210. That was a 38% return. The stock before that we closed out on May 19th was Hyperliquid Strategies, ticker PURR. We entered into the trade at $5.35. We closed out of that at $7.50. Now, I think both of these companies have more upside, and they might end up being trades that we go back into at some point here in the future. I didn't expect them to do as well as they did, as fast as they did it. And so we'll look at trading back into those companies here soon, especially after the recent sell-off that we saw. I'm not sure exactly how well Oracle did or did not do. I want to say they dropped by something like 10% and are down from their peak in June by something like 13%. So it kind of starts to look like an attractive opportunity again. Like I said, we had something like 48% returns on that. If we would have continued to hold the stock, we had a chance of looking at something closer to 60 or 70% returns. So there's definitely more upside that I see there. But, TBD on exactly how or what those trades will look like when we get back into them. So we have some outstanding trades, like I was saying. I think of those outstanding trades, a majority of them are actually in losing positions right now. I won't talk about the tickers here. That's for paying subscribers only. One of them is a major loser, down 54%. One of them we're expecting a 33% return. We're up 16%. Another one we're expecting a 20% return. We're up 5% there. And so I think if I closed out all the trades that we have right now, we would still have majority winners, and our win rate would still be above 50%. And our average return, I think, would still sit somewhere around the high teens, low 20s. So looking quite good on all of those portfolios as well. Again, something for paying subscribers that they get access to. And I think that's really all that we have for you this week, at least in regards to our portfolios, the performance, and some of our one-off stock bets that we've made. I do, however, real quick, want to recap sort of what we've seen happen at the end of this week and just quickly comment on whether or not I think it's going to be something larger or if I think it's more of a short-term reversal in some of these stock prices. So we're going to just quickly zoom out and look at the market and everything that happened from a bit of a more holistic standpoint, which is something I think is very helpful, especially when you see market sell-offs just like this one. We have been inclining every single week for 9 weeks straight in the S&P 500. So a sell-off like this one should really, as far as I can tell, come as no surprise to nearly anybody. I do think it's surprising how quickly we saw the NASDAQ sell-off, probably one of the worst sell-offs we've seen since April of 2025. But when you look at the Dow, something with a lot less exposure to tech names, we only saw a 1.35% drop. Again, still one of the worst drops we've seen in the past couple of months, but not something violently drastic that would make me super, super worried. I think what we're seeing is a lot of profit taking. We've had a lot of stock surges. We've seen a lot of shifts in the Fed interest rates, and we've seen kind of like this increasing risk on activity. And so you can't blame anybody for wanting to take some of their money off the table, especially when the no risk assets like bonds are starting to increase their yields. I think that's also one of the reasons why we've seen such a sell-off in Bitcoin. Bitcoin was the highest risk, highest reward asset that people could invest into. And so it made sense to take a lot of risk and get a lot of reward. But a huge issue arises when you stop getting that reward and you continue to maintain that risk. I think what you're seeing is people selling out of Bitcoin, and they probably were bringing their money into the market because the risk reward ratio in Bitcoin was no longer viable relative to the stock market, relative to what we're going to start seeing in treasuries if rates go up. So it puts you in this weird position where all of a sudden the highest and best is no longer the highest or the best. And so you start to see this rotation. People, of course, are now starting to pick up on the fact that we're probably going to see a hike in rates, which I don't think should come as a surprise to anybody. We've had high inflation. We haven't really dealt with it in any way, shape, or form. We've just kind of been sitting on it. And so it really shouldn't come as a surprise that those rates have the potential to be hiked. I think that that chance is now sitting at a 43% level. I will say the one thing that's making me feel like this sell-off is just kind of the market focusing on a couple of different things is the fact that we did see 172,000 jobs added in May. Of course, I think you have to watch for a revision here. Revisions are, in my opinion, almost always in the negative direction. But regardless, that should have been good news for the market. We should have seen stocks probably rise on that news. So, again, surprising that we didn't. Again, like I just referenced when I'm talking about Bitcoin, the risk reward is not there as much, so people are selling off. In the same but inverse goes for the treasury markets. When yields are going to go up, when yields are high, we should expect to see a high risk asset sell-off because it's shifted those curves when it comes to your risk reward setups. In my very humble opinion, I don't think this sell-off will end. I don't think we're going to see capital start to flow back into equities markets, back into crypto markets until we start to see that risk reward come back the other direction. So we're probably going to see, especially if we start to see the Fed increase rates, if that does happen, we're just going to see the market to stay at its current level or continue down because the risk reward curve has now been shifted in such a way that you can make a risk adjusted return that is better than what you could see in the equities markets, especially when you take into account the current overvaluation that nearly everybody agrees is occurring in the market right now. Really, I think that's the only thing that you need to be watching for right now. If rates and inflation are high, that's going to be a selling point for equities. I don't think it's worth inputting a bunch of capital into the system unless you're willing to take a ton of risk for that capital to potentially appreciate. So I really think that's how we should be looking at and structuring our view, a holistic view of the market as we go into the next month here, the next couple of months, looking at our stock trades. We're starting, the second half of this year. It's the second half of a long list of years that we've seen really high returns. And I don't think that we should just continue to expect those returns to carry on. Just like this week, we had a 9-week run of the market going up. Week 10 starts that decline. I don't think we should look at the past couple of years and say, just because we've had great performance in the past, we're going to have great performance in the future. We know that is the wrong way to come at the market. I also don't think that a 1 or 2 day sell-off is something that we should be just disastrously worried about. I don't think it's time to start selling out of portfolios, to start selling out of equities because it's all over. But I do think this drawback is warranted via high inflation, via the risk-reward curve shifting in favor of low-risk assets, given that their returns right now are so high. I think that's really all that I have for you. As you go and you look into all the trades and all the portfolios that we have offered, I think it's pretty safe to say that we can sit relatively comfortable where we're at right now. We don't need to sell off anything. We don't need to be buying into anything. I think if we got into a dip that started closing in on the S&P 500 down maybe 10, 15, 20%, I'd be much more interested in adding to positions there. Where we're at right now, I think we're going to stay relatively centered on our strategies and see what the future holds for us, especially when it comes to risk-off assets like bonds, like the treasury yields and things of that nature. So for now, that's all I have for you this week. No major changes upcoming over the next couple of weeks. We're staying relatively flat here, relatively even. All of the portfolios, our holdings, and everything of that nature can be found over on our website, thesimpleside.news. So jump over there if you need any of that information, if you want any of that information. And I will be seeing you next weekend. Have a good one.